Good afternoon, Charlie Robertson. It is a pleasure to be speaking with you today. Charlie Robertson is Chief Economist at Renaissance Capital, a friend and a very insightful individual on so many different areas. Charlie, really thank you for making time for this interview today.
Well, it's lovely to see you again. I'm sorry it's not in person this time, but it's a pleasure to chat to you always.
No, thank you, Charlie. I mean, last time we were in the Kapinski, which was very enjoyable, but this time, obviously, we'll have to make do with Zoom. Charlie, you were very early to look at COVID-19. You've done a tremendous analysis. I look at your feed on a daily basis to see what you're thinking about and how you're seeing this unfold. Would you care to just, give us a synopsis of your thinking, where we are now? You had some very interesting thoughts about how Africa probably was shielded because of its demographics to some degree, but you've looked far and wide, you've looked at it globally. So I'd really like you to start big picture and give us what you think is happening and where we're going.
Sure. I mean, firstly, I think what's important to recognize is that virus shocks like this they're not that unexpected. Virus has always been on my page of key risks for the global economy in the next year. And I think it's because of SARS back in the early 2000s. And I remember my colleagues in Asia at the time being super concerned about it. And I looked into it for the tourism impact, where numbers of arrivals into Hong Kong went down by basically 100% at the worst of the virus. So that wasn't a black swan event for me. It wasn't totally unexpected. What was the black swan event I never predicted was the global lockdown. And I think as we saw that happen in China and then the virus take off in Italy, it suddenly became apparent that this was very likely to be global, and it was going to be much deeper impacts than anyone could have forecast, even in January. Where I think has been interesting to see the changes is having had the success of lockdown in East Asia, and including low-income countries like Vietnam, and then Europe. Belatedly in Europe, but eventually they got it right. It's been a surprise to see the lockdown fail in South Africa, fail in India, Pakistan, Bangladesh, and obviously most surprisingly fail in America. It's usually when the Americans get their minds to something, they achieve a lot. It was surprising that they let the lockdown stop too early, and I think that's quite evident now in the southern states. So we've got a world economy now which is split between a kind of countries where it's succeeded, East Asia and Europe, and where economies are roughly getting back to normal, and then the rest of the world, including southern states in the US, where they're just having to get used to the virus. And you've seen the governors of places like Arizona echo what the Prime Minister of Armenia has said, which is we just have to learn to live with the virus. And Sweden, of course, is the main exception in Europe, which has done the same. So that, in terms of the big picture for the global economy, that's the main division I see at the moment. What strikes me about Africa is that there have been individual and conspicuous success stories in Mauritius, say, or Seychelles. Island nations quite well off. They've managed to make it work. But it feels to me that the rest of the continent is pretty well adopting the Ghanaian response, which is to say, okay, we tried lockdown to give our health systems a little bit of time to prepare, and now we do have to live with the virus. And our hope is that the numbers we identified right at the beginning of March from Chinese data, a lot of people criticize the Chinese data, but it was really helpful to warn us that it was going to be older people who were going to be hit, Older people, particularly, and those with diabetes, it gave us some indications of the comorbidities as well. And we could overlay that data out of China, which was confirmed out of Italy, confirmed out of Spain, and say who's most vulnerable here globally. And Africa is the continent which should be least vulnerable from this perspective.
That's on your basis of the demographics of Africa, right?
Absolutely. So the average age of people who've died in the UK, as of about 2 weeks ago, was 80. And the percentage of people in Nigeria aged over 80 years old is 0%, which gives you a fairly good clue that the most vulnerable demographics they just don't exist in a big way in much of sub-Sahara, and therefore the mortality should be much, much less.
And is that being evidenced by the numbers you're seeing, or do you think, because if I'm looking at the numbers now coming out of Africa, we're seeing an acceleration. We're at 500,000 cases now. And the speed of each incremental 100,000 is fewer and fewer days. I look at South Africa, where the numbers, you've got a test positivity rate there, Charlie, of 24% as I'm speaking to you. Even taking that into the mix, do you remain confident about your original thesis in March?
So far, the data's coming out very much in line. When I was doing a comparison a week or two ago about Italy versus South Africa, and we took the same kind of point of cases, or the first, I think, one death per 100,000 people, and I took that as a starting point. The numbers in Italy then have risen 5 times higher than South Africa over the same sort of period of time. So it does look like it's working. South Africa does concern me a little, because this comorbidity issue of obesity, increasingly doctors here in the UK telling me this is as much a cardiovascular disease, which is where it's interesting the Burundi president died of a heart attack. It fits with that. He was diagnosed with coronavirus, I think, a month ago. That issue of obesity is quite high in South Africa. Something like 26% of the population are obese. So it's possible that South Africa is going to be hit more than most in sub-Sahara because of this issue of diabetes and obesity. But still, the numbers should come in much less, and appear to be coming in much less than in Europe. There's always the issue of, are people testing enough? And the data for tests for most countries is much less in Africa relative to the population than some of the more successful countries like Vietnam, for example, in East Asia. And also there's the possibility that deaths get misrecorded. I have a friend of mine who had the virus 2 or 3 weeks ago. She was telling me that the symptoms are really much like malaria. It wouldn't have surprised her if people are being misdiagnosed, or even in terms of not bothering to get tested in the first place, or when they die, perhaps it being attributed to the wrong disease.
Today, if I may back up a little bit, today you were saying that, what we're seeing is the virus spread from the developed world into emerging and frontier markets, inclusive of the US. Now, if you look at all the data points, we're seeing big surges. Brazil, Bolsonaro's got it now. Latin America, ex-Asia, in more this Pakistan, India, Bangladesh area, we're seeing it. How would you characterize that point that you are making?
But aside from the United States, where I think it was an ideological decision in mostly Republican governors' states to ease up on the lockdown very quickly, and in many regards just following the Swedish kind of example here. Elsewhere, it looks like the informal economy was just too important, too big really for lockdown to work, and as a result, you've seen that virus spread. We've still got minimal amounts of economic data. to be able to say, this is how it's played out over the last 3 months in various countries around the world. So it's still hard to judge which has been the right policy on that front. But my base case is that we should see less of an economic hit from the virus anyway in the second half of 2020. And considerably more issues, at least kind of worries about restaurants, services, travel in parts of the southern states of the United States. So it's still a very mixed picture, and there's still very little data for us to go on.
Let me now take you to the financial markets. I mean, both of us have watched these markets for decades, and really what unfolded from the beginning of the year and the velocity of what unfolded was simply unprecedented. I mean, what we saw in the FX markets, what we saw in bond yields in emerging markets. I've got to give you credit, because I remember an interview you gave, I think you gave to Bloomberg. You practically caught the bottom of that, and subsequently we've had this very good rebound. I'm sure a lot of your folks, investors, must be very happy. But describe a little bit of that and the real, are you striving to the V-shaped recovery? Do you think this is a more permanent circuit breaker? How do you see, and I know we're in a kind of data black spot, we're not getting all the data, but how would you pull that together for us?
Well, as you said, it was an unprecedented move in the markets in March, to the point where I was worrying that they would shut them down for a week or two, as they did around 9/11. It really looked like a dysfunctional problem, and it was impacting on everything. But I was super impressed by what the Fed did, what the US Treasury, what the government did, and in Europe, and they pulled it back. And I think what became clear in April was that the hump in cases would reassure the markets. We'd seen the hump in cases in China, we'd seen it in Italy. It was plausible that we were going to see it elsewhere. And that really helped give us some confidence that the markets then would recover. And anyway, some of the markets were hit so badly that it almost didn't matter quite when you caught the bottom. I was perhaps lucky in April, May, because you were buying such value when you put money back to work in emerging markets at that time. So that's where we were at that point. So I've got noise. We pause the interview for a second.
Yeah, sure. Let me do that. Yeah.
Yes. So the markets found their bottom in April. I think what's happened since then is two things. Firstly, debt markets in the States and Europe have said, we're going to be burdened with high debt for a long time to come. Interest rates are going to remain extremely low. And if you're an investor in the States now, and you've got your retirement fund, you can lock in 0% yield for the next 10 years, or you can invest your money instead into the US stock market, pick up a dividend yield, which is going to be much stronger. Even if it's 3-4% a year, at least that's something. And I think that's what's driven the S&P up so high. The difficulty I've got right now is that historically, when the markets have crashed, there's usually been a second dip. And we could be getting very close to that within 2 weeks of now. Historically, when we've looked at 1937, which is the double dip of the Great Depression, or the 1970s oil crash, or the tech bubble, or the global financial crisis, there's usually been a second dip. And that would be, in this circumstance, either because lockdowns get reimposed in the southern states of the United States, key parts of US GDP like Texas or Florida. That's not my base case, but it's not the base case of the markets either, which is why they'd be shocked and which is why they would go down if that does happen. the second possibility is that the markets recognize just how tough the economic impact is of COVID, the tens of thousands of jobs now being lost on a more permanent basis in airline sector and potentially in other service sectors where it's clear that we're not going to get 100% recovery back into restaurants anytime for 6 months, maybe 12 months, maybe not until a vaccine is brought. So either way, whether it's a resurgence of the virus or the market's getting upset by the joblessness issues, there is the risk of a double dip. So on a 3 to 6 month view, that makes me concerned about where we might go in the second half of this year. But 2021 onwards, I think it becomes easier to forecast what I think is going to be a very bullish run for emerging markets in particular.
Let me come back to that, because you've made two great calls which I'll never forget. One was on Egypt, when Egypt devalued, and I was in a debate with Robin Brooks of the IIF yesterday, because he was taking a data set which he was ignoring that devaluation, and you call that, and then you called Pakistan as well, and this year you called the dip. So just give us a little bit of where you are bullish in emerging markets. You're telling me I'm not so bullish right now because it's come back quite a lot. Is that correct?
That's right. That's right. I think the most important shift of the whole, the most important political impact of the whole virus is oddly not been the impact on political leaders from the virus spreading very widely. I was surprised that opinion polls in Sweden, where they've got a very, very high level of deaths per capita, the main governing party has shot up in the opinion polls by about 10 percentage points over the leading opposition party. They were behind that party in February. And as they've conducted their strategy, they've got more popular, despite the deaths.
How interesting.
What does seem to impact on political popularity, though, is jobs and the economy. And for the United States in particular, there's a very strong lesson from the last 100 years that presidents who preside over a recession in their first term don't get elected in the second term. Those who have a great economy do very well and have a good chance, in fact, always get re-elected. But they always lose if they have a recession. And when I used to say this, even a year ago, my Democrat friends in New York used to get quite upset because the implication was Trump was going to win again. But the very clear message now is he's going to lose. And we put out a piece on that in May, at a time when the betting markets and indeed some of my clients told me I was wrong. There's been a dramatic change in opinion polls and market sentiment, and it's now pricing in this Biden victory. Now, why is that important? Is because Trump did succeed in getting more foreign direct investment into America with his tariff policies, and he did succeed in deterring American companies from investing abroad. And what that did was two things. Firstly, put less money into emerging markets, and secondly, created a strong dollar. Both of those factors have hurt emerging markets in recent years. Both of those factors, I think, will start to change in 2021 with a Biden victory. You're going to see American companies say, we don't have to worry about tariff wars and whether we have onshore production. We can now look to be in the most cost-effective places to produce, which might be Mexico instead of South Carolina. And I think that will then contribute to a dollar weakening trend. The dollar is overvalued, but it's been overvalued now for a number of years, about 10% overvalued at the moment. So that weaker dollar trend then means you start putting money into emerging markets in 2021, and the weaker dollar is then working with you. It's making dollar debt of emerging markets look less as a percentage of GDP. It's often helpful for commodities. A lot of emerging markets still are commodity exporters. And it means if you're selling your dollars to go and buy Kenyan shilling or Turkish lira or Russian ruble, whatever it is, that in the main, those currencies are going to be strengthening and therefore giving you an extra return in dollars. So I think the big shift in 2021 and beyond is going to be as a result of the US election in November. Between now and then, who knows what the president might do? We could see fresh tariff wars. There's been talk of an attack on the Hong Kong dollar peg by the US. I mean, there's a lot of short-term issues that, again, create uncertainty. But post-November the 3rd, I think it's November the 3rd, we have a more interesting trend for the next decade, I think, for emerging markets.
Can I just segue into the geopolitical situation that we find ourselves in? I mean, it seems extremely adversarial right now. You were talking about the tariff war, but we've got Hong Kong now as a big flashpoint between the US and China. It seems that the West has stood down on Hong Kong, to me, besides saying, you know, the story about the Hong Kong peg. We've got a very volatile South China Sea. The Chinese have, I think, performed at about 18% of the total performance that are expected from that phase one trade deal. You listen to the language of both sides. I mean, it is very, very testy. You've got the wolf warriors, Xi's wolf warriors, like the gentleman who's the editor at the Global Times. You've got Pompeo. You've got, you know, is this noise, or is it speaking to a deeper malaise and a problem in your mind?
No, yeah, all of those issues you've raised, I think, are important, and I think what's been clear in the last few years is that Trump going against China on trade has actually won quite a lot of support across the American establishment. People see it as a geopolitical rival, as you're saying. The tech companies don't like being excluded and pushed out of the Chinese market. There's the intellectual property theft issue. There's, even with the G20 debt forgiveness issues, there's this rivalry going on about how much should the Chinese be involved in this as well, and somewhat reluctant to be, it seems, early on. They seem to be getting there now. I don't think any of that's going to disappear. Or maybe it lessens on the trade tariff war, but the rivalry between China and the US is likely to continue. But what has been striking about the Trump presidency's attitudes here is that he hasn't just gone after the main rival. He's gone after all of his friends and allies as well. There's been trade war threats on Europe and Japan and Korea and the rest. What would be normal behavior of a country seeing a rising rival is to gather around your friends and work more closely with your friends, perhaps be even more helpful on issues like trade with them, to build an alliance against China. And I suspect that that's what a Biden presidency will be closer to. So Americans may well encourage their own companies to put factories into Vietnam or Korea or others in Southeast Asia instead of China. But this is a pro-globalization approach rather than a blanket protectionist anti-globalization theme, which is what the Trump presidency has been about. So it's the rivalry between America and China absolutely continues, I suspect, but it's not an anti-globalizing issue as it has been for the last 2 to 3 years.
I'm aware of time, so I want you now to take you to Africa. You touched on China, you touched on this debt forgiveness issue. Just give us a little bit about that, and then can we just go into how you're seeing the economy play out on the continent over the next 12 to 18 months. You know, we went into this crisis in Africa with balance sheets pretty maxed out, if I think about it, whether it's in Nigeria, South Africa, Kenya. So my first question to you is China going to be nice and generous to Africa at this point in time, in your view, firstly? And then, you know, is it the elephant in the room, or is it a part of the solution? How do you see things from that perspective?
Yeah, the G20 debt forgiveness idea, I think, is the second best solution found by Europeans and the G20 in general, because the US has not been interested in taking the proactive approach that the Obama administration did in 2008-9, particularly that G20 meeting in I think it was April 2009, which really gave a massive tailwind to the global recovery. The US administration has just not played ball on this and has prevented the IMF from expanding special drawing rights, which would have given it much more firepower to help the world economy, and particularly the most vulnerable countries, the poorest countries facing this virus threat. So what I think has happened is the G20 has turned around and said, well, what can we do? If we're not going to provide super cheap financing, either directly or via the IMF, what can we do? And they've gone back to the 2005 playbook of debt forgiveness, which I think isn't ideal, because it rewards countries that are most indebted, like Zambia or Angola, without addressing the countries that perhaps have the biggest health issue. Well, it certainly isn't addressing countries equally. I mean, if the virus spreads equally through the continent, why should it be the countries with the most debt that get the most support? So I don't think it's ideal. And the idea of then penalizing the private sector, I've also thought was odd. You know, for years, the push has been, how do we get the private sector to invest more into Africa? And then the first big economic crisis that comes along, bang, you penalize them. You reward and bail them out in New York. You know, the Fed cuts interest rates, and you know, stock markets are encouraged upwards in the US, but when it comes to Africa, no, you penalize the investors, the private sector investors, instead of rewarding them, as happened in the States. And I'm very anxious that if that had been pushed through for longer, I mean, it feels like the G20 is now stepping back and saying, no, we're going to do a public sector response here, debt forgiveness from the public sector. We're not going to penalize the private sector. But if they had pushed that through, I think it would have been very counterproductive on a 5 or 10 year view, because investors would have learned one lesson. If there's a crisis, buy Google, because the stock market will be bailed out by the Fed. Don't lend to Africa, because you'll be forced to take a haircut on that lending and an extra loss. So I think it's quite important that the G20's backed away from that. But I think a lot of what they were trying to get at all along was getting the Chinese involved. The Chinese have played such a massive role in lending to Africa and building up debt in Africa at cheap interest rates, to give China credit, but also much to China's advantage. Much of the lending, you know, the standard gauge railway, for example, in Kenya, you've lent money by Chinese banks to Kenya to build a railway by Chinese companies using Chinese cement and still employing, I think, Chinese train drivers on that railway line. So this has been an implicit subsidy by Chinese banks to Chinese companies. And I think there is a good case then to suggest maybe they can take a holiday, payment holiday on the interest that was due to them in 2020 or possibly 2021. I mean, further out from this is going to be a tough year for Africa, obviously. Commodities are down, so it's going to feel as bad as 2015 for countries like Nigeria or Angola. Tourism's been hit, so Morocco, Kenya, Egypt are all going to suffer significantly. I find it quite weird that the European Union allowed Rwanda to open up flights from Europe, but not Mauritius. Mauritius, you know, really successful fighting the virus, so why not Mauritius? But nonetheless, the point is, tourism's been hit, so it's going to be a very tough year. But feeding through into the next decade, I've already outlined, you know, why I suspect the dollar is going to be weakening, why foreign direct investment is going to be going back to Africa. But this other key theme is that the cost of borrowing should be as low in the next decade as it's ever been for Africa, partly because the economies are getting, over the longer run, stronger, and partly because the US interest rates are going to stay so low for so long. And so those high debt ratios that look awful when US treasuries are yielding 3% and you need 3 or 4% above that to lend to Nigeria, say, if US treasuries are going to stay at 0 to 1%, 3% above that is implying Nigerian dollar borrowing costs of 3 or 4%. Okay, maybe not that low, but maybe it comes in at 4 or 5%, but still lower than it's been, which means that you can handle bigger debt burdens. You can afford to borrow a bit more over the next 5 to 10 years, and perhaps drive growth that little bit faster as a result. That's my core scenario now for the 2020s.
So, Charlie, I'm really grateful for you taking the time to talk to me. I'm really grateful, and I'm glad to see that you've still got a bull case which remains intact. It looks like it's from 2021, and I look forward to drilling into that further to give, to pick your brains onto what are the compelling trades. But I think I've got to wait a couple of months for this double dip you're talking about before we step in bigly.
That's still what I'm concerned about. Yeah, it's and I think November. I think the key thing to be waiting for is those chief investment officers of US pension funds who are going to turn around at the end of this year and say, okay, we have a change of president, I think, and what does that mean? Where do we put our cash to work in January the 1st? And I think the reallocation you'll get from global pension funds, global mutual funds towards emerging markets is going to be the big positive driver for next year.
Thank you very much, Charlie. Much appreciated.
Great to talk to you.
Take care.
If we're going to stop it there,